Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. And it is not Monday.
No.
It's Wednesday. There are going to be a lot of Wednesday ETF IQ shows.
Just for the next month or so.
For the next few months. We've got holidays, Juneteenth. We've got July 4th coming up.
Big.
So anytime you miss us on a Monday, make sure you check us out then on a Wednesday as we dive into the more than $7 trillion ETF industry. Let's get to the top stories. JP Morgan CEO Jamie Dimon warns investors should prepare for an economic hurricane. We'll take a look at the ETF flows and dig into the psychology of investing.
Plus, the BlackRock ETF sees its assets soar by $2 billion in just 5 days, raising speculation of an allocation shift. We're going to dissect portfolio construction. And
investors are seeking shelter in cash-rich companies amid the volatility. As a result, cash ETFs, including COWZ, are breakout hits in 2022.
And Matt, Eric Balchunas is in Hollywood, Florida for an ETF conference. I'm going to go with the flows this week. And if we look at where money was moving around on a weekly basis, actually it was a pretty bullish shift. You can see up there at the top, you have a trio of S&P 500 tracking funds, money coming into there. You also see some corporate credit in the mix. Look at JNK, LQD up on the leaderboard as well. But if you look at what was losing money, still not a lot of appetite for tech. You have QQQ losing another $2 billion. You also have XLF, that's a financial sector fund, losing money for yet another week. I'll get into that a little bit later. But again, Matt, it's a pretty bullish week overall, I would say.
All right, let's bring in Eric Balchunas from Bloomberg Intelligence. He just does join us out of Hollywood, Florida. So, Eric, what do we need to know?
And Eric, what's next on the agenda? Obviously, you have that ESG panel coming up. Anyone following your Twitter knows that you're a very busy guy this week. What's next on the agenda?
Yeah, I mean,
Eric, great to get some time with you. Make sure that you see at least a little bit of the sunlight. That is Eric Balchunas. Now, we mentioned Jamie Dimon and his comments earlier that are getting investors' attention. Here's exactly what he had to say earlier at a conference. Joining our conversation now is Dan Egan. He is Managing Director of Behavioral Finance and Investing at Betterment, which has $33 billion in assets under management. Dan, great to have you with us. Betterment, obviously a huge robo-advisor. What are you hearing from clients? Are they also worried about that economic hurricane that Dimon alluded to?
One of the big shifts, I think, over the past 3 years.
And Dan, I want to go back to that point you made at the beginning, that you're starting to see the froth come out a little bit, the slowing of offense. How does that trickle into, your ETF investment selection, your process there?
So we are always looking to
ETF investing rather than putting customer money in mutual funds, for example.
We put no new customer money into mutual funds at all. We can sometimes take them on if the customer already has those as an existing holding, but all deposits go into ETFs or, in some cases, a savings account, a cash interest-bearing savings account, but no mutual funds.
And what is the current thinking on crypto investing right now? Obviously, the crypto market at a pretty difficult spot. You recently acquired Makera, though. I know you have intentions to offer crypto in portfolios. Where are you in that process?
So we're still ongoing, bringing them on, making them.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And I wanted to start with the fact that there is absolutely no love for banks right now. You're taking a look at XLF, that's State Street's financial sector fund. As you can see, May was its fourth straight month of outflows, even though in May, actually, this fund rallied 3%. That was its first monthly gain this year. Did not show up in the flows at all. But I also want to talk about crypto, and for that, we're going to turn to BITO. This is the ProShares Bitcoin Strategy ETF. If you take a look at the put to call ratio, it's at about 1.6 right now. That is close to a record in this fund's history. BITO, of course, down 33% already this year, but it looks like traders are bracing for more Bitcoin losses ahead. And Matt, I want to end with a meditation of sorts on model portfolios, because I was taking a look at the flows. I was taking a look at the iShares MSCI Emerging Markets Min-Vol Factor ETF, ticker EEMV. As you can see, there was not much going on, and then boom, billions of dollars. Now, that has industry experts thinking this was a model portfolio allocation shift, which of course have boomed in popularity and would explain why really sudden, huge inflows there.
All right, it'll be interesting to find out what that was. But for me, the put-call ratio on BITO it's either scary or it's alluring.
Yeah.
Right? Because that's blood on the street. That's when ideally want to buy if you have the courage of
Seems very one way, right?
Of your convictions. It certainly does. Let's talk more about these issues with James Seyffert of Bloomberg Intelligence. James, first let's talk about the emerging markets min-vol flows. $2 billion in just 5 days. Do we know anything more about what drove that?
Yeah, I mean, it started off with a whopping.
And James, pitch me on model portfolios, because it's hard to get an exact number, but I've heard estimates that there's trillions of dollars in these things. Why do advisors like them so much?
Yeah, it's
James Seyffert of Bloomberg Intelligence, thanks for stopping by. Still ahead, we're going to drill down into high-yield bond ETFs with Joanna Gallegos, co-founder of Bond Blocks, next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller, along with Katie Greifeld.
It's time now for today's drill down, where we focus on one ETF. We're going to talk about another Bond Blocks ETF. Remember, we had them on the show a few weeks ago. They launched 3 more junk funds last week, and today we're taking a look at their Triple C junk fund. The ticker is XCCC. It charges 40 basis points, and as the name implies, it holds mostly Triple C rated debt. If you take a look at the holdings, 97% rather, of the portfolio is in Triple Cs. If you look at the maturity, it skews a little bit shorter. Most of this fund is in bonds that's maturing in 7 years or less. And the reason I wanted to talk about this launch is because it's ultra concentrated. If you look really at the asset class in ETFs, this fund has the most Triple C rated debt of any ETF on the market right now. You do have HYLS in second place, but it's a distant second place with only about 26.5% of the portfolio in Triple Cs, Matt.
All right, Katie, thanks very much.
And Joanna, you launched 7 sector-based junk funds in mid-February. They have about 40 million in assets or so. Do you chalk that up to the market in general being kind of stressed out right now, or is there something that's not yet singing when it comes to pitching this to the investors?
Yeah, fixed income.
And Joanna, we only have about 30 seconds, but I'm curious, who's the ideal investor for these products? Who are you pitching to?
I think we're talking. Right.
All right, Joanna Gallegos of Bond Blocks Investment Management, thank you so much for your time. And before we go, here's a special look at a pair of breakout cash ETFs. Cash is king in 2022, especially for a couple of Pacer US Cash Cow ETFs. First up, COWZ, which tracks mid and large cap companies with high free cash flow yields. It's become a breakout hit with around $4 billion of inflows year to date, about an 80% jump in fund assets. The second fund trades under the ticker COWZ and has the same objective, but uses the S&P Small Cap 600 index. Both funds have had success looking for companies with strong cash flow, healthy balance sheets that trade at a discount, and show long-term potential. They also weight their holdings according to each company's 12-month free cash flow, capping each name at 2% at the time of the quarterly rebalancing. COWZ counts a number of energy firms among its holdings, including names like Exxon, Valero, and ConocoPhillips. Meanwhile, COWZ features blooming brands, Warrior Met Coal, Contour Brands, and Big Lots. There's a big divergence in size between the two funds. COWZ is significantly bigger with roughly $5.5 billion in assets, while COWZ has about $840 million. COWZ has a lower expense ratio as well. Both funds get a green light in the Bloomberg Intelligence traffic light system with a notice for their alternative weighting.
All right, I think it's amazing. I've been talking about COWZ for the last couple weeks after I think either you or Eric pointed it out to me on ETF Go.
Yeah.
Me and Paul Sweeney, we're all in.
You're all over it.
Yeah,
well,
yeah.
Everyone's all in, it seems like. This fund, COWZ, it's actually at $6 billion. Just last week I wrote a story about it. It was at about $5.5 billion. So people continue to just funnel money into this thing.
Not funny money, though.
Funny money. No,
legit.
Real cold, hard cash into COWZ.
It could be because I've been talking about it on my Bloomberg radio show.
Yeah.
Yeah, a lot of people listen. I do want to note that we will be back on Wednesday again next week. This is because not of Juneteenth or the 4th of July, but another holiday for us in the financial news industry. It's Apple's Worldwide Developer Conference. So tune in Wednesday at 1 p.m.
You know, a lot of people are saying that Wednesday is the new Monday, so we'll see how it goes. But it is at 1 p.m.
Actually, I had a producer once say, we should do this show on a Wednesday. And I was like, you're crazy, Tim. We're going to do it on Monday. But man, I guess he was right. That does it for Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld. This is Bloomberg.